Good morning, everyone. Thank you again so much for joining us here today on our Singapore strategy. On behalf of Phillip Securities Research and Poems, I'd like to wish everyone a very blessed, happy, and of course, more importantly, prosperous 2021. So today we'll just run through our 2021 equity strategy. If you go to the chat on the Zoom, the chat portion of of this Zoom, we actually posted the slides for you. We also posted the link to the strategy report, and we also posted a link to our recently quarterly magazine, which we focus on the property sector. So do look out for this, and because we take feedback from everyone. So we understand that everybody wanted to have a look at the slides first. So we actually posted this, and the questions that we cannot address, we actually also will try to address them and post it in our Stocks B&B website. So we take whatever feedback you give us, and we will try to improve. So thank you for all the questions. So let's move on. I think our strategy for 2021, we actually mentioned equities in the sweet spot. So the rationale for this is, at least for the Singapore context, is that we will get that economic rebound, and then we will. Then the other reason, as you can see from the chart, is also the fiscal policies and the record low interest rates. We'll dwell on it in depth later on. So I'll move on to the next slide. Okay, our disclaimer, I think everyone has to bear with it. The disclaimer basically means, we take public sources. These are all our opinions. Okay, for the agenda today, I think we have like almost 80 slides. We will just have a review, as usual, when we start off any presentation, just have a review 2020 performance. How did the equity market and STI perform? Economic conditions, some of the macro drivers or macro themes. Bayron will also run through the technicals, and he will give his number one pick based on the technicals for the Singapore market. All our analysts are here, and they will provide you their sector views. And we will also have one slide on all the stocks that we have buys. For us, buy or accumulate is the same thing. It's still technically a buy. Buy for us maybe is almost like a strong buy. And then we will also have one slide just to give conclusion for the whole presentation. Okay, let's start with a review of 2020 performance. Obviously, this is not a good chart to start with. As a broker, we always want to see the bull, but anyway, I'll explain to you why we have a bear here. Okay, on this slide, let me just run through. I know it's a bit complicated. I'm just showing you how did the STI perform in the past 3 years. So the red bar is how the STI performed in 2018, then blue is 2019, 2020, and how we perform STI, Straits Times Index perform against, it can be bonds or gold, and these are not just the spot prices, these are ETFs. So you technically, you actually can take a position on this because you can see and the notes at the bottom. So the corporate bond ETF is the LQD, and then gold is of course the famous GLD. So you can see that in 2019, it was everything rallied. So Singapore rallied, the US market of course rallied 29%, the blue bar, and then bonds rallied, gold rallied. But the problem was in 2020, everything rallied but us. So you can see the US market rallied again, the bonds rallied again in the yellow chart, gold rallied, but Singapore didn't rally. So everything rallied but us. So I want to run through this chart fast, so hopefully no one can remember it, but let me just move on. Okay, then in terms of what dragged the STI down, STI is 30 stocks. So this is just a rough estimate because we don't compile it every month. So this is just a rough estimate as to, I wouldn't use the word culprits, but if you want to blame who actually helped to drag the index down for at least 2020, you look at the names on the right, and then on the left are those who helped the index. So what helped drag the index down for 2020 was Singtel. So Singtel was down, I think, almost 30%. Then, of course, the banks, but by default, because the banks have such a heavy 40% index weight on the STI, so they naturally will have impact on the index. So these were some of the names that drag the index down, just for your reference. So 2%, our rough estimate means 2 percentage points. So out of that, the 11% weakness that we saw, or 12% weakness that we saw in the STI, I think like 2 percentage points roughly came from Singtel alone. Then another Another chart here, we just wanted to pinpoint, so which stocks actually again drag the index down. So of the 30 index on the STI, sadly only 9 had gains. So again, no worse than Baccarat, I guess. So if you look at the, 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 the bars on the top left-hand corner, so you can see that it's hard for the STI to rally when 40% of the STI components, which is mainly the three banks, were in the red. Of course, UOB performing the worst. You look at the bottom rate. So these were the worst performers. Singtel was down a huge 30%. SIA, obviously, we know that the reasons. And Jardine is like a cargo carriage because of the performance of Astra and the weakness in car sales. The REITs actually did well. Actually, the maple trees did well. You can see at the top. Then just quickly, the property stocks also were hit because of their link to hospitality and retail, especially hospitality, as we know from CDL. So the one on the far right, those were the big performers. The best performer was Semcor Industries after they did the merger. Then of course we have Capital DC and Venture. And the bottom is just how did the consumer stocks perform. So actually Genting, I guess relatively a performer, although it's down. The worst ones were Thai Bev and Dairy Farm. Okay, the next slide. This is our final slide on performance. We don't want to delve too much on the past, but if you want to look at who did well sector-wise for 2020, it was the healthcare stocks. But when we say healthcare, we actually included the glove stocks. So the glove stocks did amazingly well. Electronics also did really well, the whole electronics. So you can see that electronics did as good as the healthcare segment, mainly helped by, because these are index weighted, market cap weighted. So the large portion of it was due to ventures performance. REIT industrial also did well. The worst performance was, as you can see from the far right, shipping actually includes Sembcorp Marine. So I guess they did, they did a rights issue for everyone to kind of lose money in a way. Then transportation, of course, we have SIA, and then telcos with the Singtel. So we just wanted to start off the presentation just to let you have a flavor of what was the reason the STI was so weak. Okay, let me move on. So in terms of the economic conditions, when we do economic condition, we don't want to do too many slides. Economics is like the art of saying a lot, but nothing really nothing much of importance, I guess. So anyway, our first slide, we just wanted to look at Singapore. So our GDP on paper for 2020, which the flash estimates is that our GDP will be down a negative 5.8%. So this is the worst. This is the worst since I think you can see the numbers up to 1960. So this is the worst contraction ever. But I guess the unique thing about the decline this time around is, in part, it was intentional. I think this wasn't due to weakness in global growth and so forth. This was because we intentionally had to shut down the economy due to the pandemic, and that's why we got it. So we had this recession. So in a way, the turnaround can be fast, and because you shut it off and then you shut it out, you turn back on the economy, then the rebound can be sharp and can be more pronounced and be a bit more obvious. And then the first bullet point there is just wanted to show that 2021 is going to be the largest reversal. So what it means is that we are down 5.8, but we will be up 5%. So there'll be a big, like almost 11 percentage points increase in GDP. So you get that big momentum in terms of economy, because you shut it down, now you turn it back on. The slide at the bullet point at the bottom is just to show. So I was curious, like whenever we have a deep recession, how did the STI perform? So it's a bit mixed, but most times we do get a good market rally post a deep GDP contraction. It's only in 2002 that it was still a negative after the 2001 the recession. And most times we actually do get a big rebound in the equity market. But again, doesn't mean history will repeat, but I just wanted to have a quick reference point. Okay, just one slide on what's happening globally. So this is just the global PMI, just to show what is the current economic conditions. So you can say in a nutshell, manufacturing is having a good time, I guess. You can see there is a V-shaped rebound, and US has been exceptionally strong. And it's not only just US, globally, Europe, emerging markets, China. So you can see that some of the indexes are at multi-year highs, 2 or 3 year highs. So global manufacturing actually performed well or coped well with the current pandemic. Okay, if you move on to Singapore, we like to use this chart because it's a daily chart. So this is a Google mobility indicator. So it just gives you a reflection of how activity is. Zero is the January. You can say this is like the pre-pandemic levels is zero. So you can see from the chart when we had the circuit breaker. So this chart was quite effective. You can see that when we had the circuit breaker, the first gray bar on the left, activity just collapsed to minus 70 and so forth. Then as we had phase one, activity started to improve. You can see the sharp rise in the rate sharp rise. I mean, everybody had to go to work because it's the workplaces. Then the third bar, then when we had phase two, it started to improve. So right now, if you read this chart, the workplace activity is still below trend. That means not everyone is back to office. So maybe 80%, you can see the red bar or the red line. And then for retail, is maybe 90, but grocery spending, I think you can see from Sheng Siong results, is back to essential shopping, I guess, is back to pre-COVID levels. But transit is like MRT. So all these are still below the pre-COVID levels, and it will be expect things to only to creep up slowly as we enter into phase three. Okay, we will just have two last slides on economics. We will just have one slide on US and one slide on China. So for US, I think this is probably the most important slide, I guess, just to show you how the stimulus, the 3 trillion stimulus that the US government injected into the economy, how it helped personal disposable income. So any personal disposable income, you can just think of it as the accumulation of all the salaries and all the income for all the businesses, especially the small businesses. So you can see that in the 2009 recession, the first rate circle, income obviously declined because we had a recession. But unusually for this time around in 2020, income actually spiked up. And that actually helped build up the US economy, and I think even the global economy, because income levels for individuals and small businesses actually spiked up. You can see it hit almost 19 trillion. But it should be actually maybe 17 and it should actually be declined. So this big jump that you get was because of the stimulus. And this stimulus is one thing unique about the stimulus that we got from the US is it's a handout. No? So this stimulus is not to build any bridge and then you get the secondary effect of economy improving. So this time down, the government basically just put money into your pocket. And as you can see from the bullet point, and there will be a second stimulus coming up, about 900 billion. And to give you a flavor of the stimulus, though each individual adult will be given $600. Thank you very much. And then or a dependent will be given 600. That is one off. Then for those who are unemployed, you'll be given an additional $300 per week. So you can see how much handouts the government is giving. The first stimulus was about 600, so this time it's 300, but they're still stimulating. So this will help prop up the US and of course even the global economy. Okay, this is just our last slide on economic conditions. So this is China. I mean, you can probably pull out 50 slides on China, but for us, one of the more important ones is whether China is leveraging up or China is not leveraging. So you can see from this slide, this is the net disbursements. So this is not, this is like the amount of money that's being injected. I mean, of course they got total social financing, but this is just a rough estimate of the amount of money that the authorities is injecting into the economy. I mean, just a rough proxy. So you can see from January 2020, this year was when they did very aggressive stimulus. So you can see that the prior, in 2019, sorry if it's a bit hard to see, but it's a bit flattish. Now they were injecting maybe 17 trillion per month roughly. This is a rolling over the past 12 months. This is not a monthly injection, but over the past 12 months, they were injecting maybe like 17 trillion. But in January onwards, in view of the pandemic, China just injected huge amount of liquidity into the economy. So that's why that again also helped the global economy in China. This is obviously going to be positive for commodity prices with a lag. The reason we say this is, once you inject all these loans, then there will be a rebound in fixed asset investments. They'll be building more bridges and so forth. So that will help accommodate, and that's why the housing prices is very strong. And I think later Jeffrey will mention about first sponsor, like how that even you have to pay money to even queue up to buy property in certain cities. So that is what's happening, helping the Chinese economy. Okay, so that's it for economics. Again, no, economics is the art of saying a lot, but nothing that's of much relevance. But we'll move on to our macro themes. So before we move on, we obviously want to check, like, a year ago, we also had teams, so we don't want to double check, we just have to check ourselves and just provide some transparency, whether the teams that we mentioned last year did actually work out. So now last year we had just as a refresh, we were expecting a ceasefire, so that kind of worked out. We actually thought that in 2020 there'll be a big domestic recovery, because we saw record FDIs and the economy was starting to pick up, but obviously COVID kind of derailed all that. Again, we mentioned buoyant electronics, so that panned out and even better than expected. Binary political events because of the election, and then less momentum in rates. We actually expected interest rates to actually rise, because we thought the economy was a bit overheated, but that didn't work out, so that was a fail. But do read the green bullet point at the bottom. As MOE said, the PSLE marking is about learning. It's not a race to outdo others. So if there's a fail, please read the bottom disclaimer in green. For 2021 teams, what we are expecting is a boom in global growth. We also the key thing will be, of course, vaccines. We expect the vaccines to bend the infection curve. And the other key theme is that interest rates will be conducive. And this is important because usually any expected rise in interest rates kind of derail the market or even derail the economic growth. So that is another theme for us. And of course, we also think there'll be a prolonged growth in tourism, or the so-called revenge travel theme. Okay, let's move on to our first theme. So in terms of vaccination, I know there's a lot of numbers here, but so basically, these are the top 10 candidates of a COVID-19 vaccine. In blue will be those that have been already approved. So as we all know, the Pfizer, Moderna. So the message here is that you can expect a lot more vaccines to be approved. The big one to watch, of course, AstraZeneca has just been approved in certain countries, but the big one we want to watch is the J&J. The reason is because J&J, the dosage is only one, so you don't need to have a multiple dosage. The other point here we wanted to say is that based on the capacity announced, of course, we will never know whether this capacity is effective or not, but based on what has been announced, there's almost 9.3 billion doses available in terms of capacity. And you work out the sum, this means that there's enough vaccines for 5.25 billion. Of course, the vaccination curve, how fast they can roll out vaccination and inoculate everyone, that is obviously going to be bumpy and unclear. But what we wanted to show is there is enough vaccine on paper, at least to vaccinate the large part of the developed countries. So as the vaccination progresses and as we monitor this, then this will help the revival in global growth. If you allow, again, every week we actually do this chart, but we will just wanted to update on how COVID cases are trending. So the cases are still elevated, although you focus on the blue line. The blue line is the number of worldwide cases. It is tapering down, so that's a positive. But to take it into context, these numbers are still double the levels 3 months ago. And of course, some of the reasons why it's down because Europe actually has been containing it better. The numbers in the US seem to be I'm not sure if this is the third wave or it's still climbing back up and hopefully not turn into a fourth wave. The sad thing was in Asia. So these are the cases in Asia. You can see the numbers in Japan. This is a major third wave undergoing. So we never expected Japan of all countries to have a reinfection. The cases to climb back up. We see it in Malaysia, probably entering to MCO. So in Malaysia, the cases are averaging almost 2,000. So again, you are experiencing record cases in Asia, which actually we thought they were being contained. As you can see from South Korea, the numbers were actually very low, but again, even Korea is also experiencing another third wave. The good thing for us, we wanted to show what's happening globally is just to also show that in Singapore, unlike many other countries, the cases are low. We are having a reasonably good we are having good control of it, and also Singapore, unlike many other countries, is easing up. I think we know that countries like Germany, UK are all under lockdown, or California, but in Singapore, the unique thing about us is that we are easing it instead. But albeit the number of cases are still prevalent. I think year end we had a recent spike at year end, so this is not going away. Okay, the other theme will be on the low interest rates. So the blue chart here is the amount of negative debt. So this is the amount of debt. I know it's a bit ironic. That means this is negative interest rate debt. So what it means is that when you buy this debt, instead of you collecting interest rates, you technically have to pay them instead. So this is record negative debt in terms of corporate and also government. So the reason why I added the Bitcoin, I know there'll be some questions on Bitcoin, but you can see that it doesn't replicate one for one, but you can see that the jump in Bitcoin has some reflection of the amount of negative yielding debt. The second bullet point, like trading tulips, this is not my comment. This is Charlie Munger's comment. So I guess his view is just that buying Bitcoin is like trading tulips, just hoping for someone else to take it off you. But again, so I guess the basis for the Bitcoin is it reflects the loss of central bank trust. And I guess the only one merit we can say is that with Bitcoin, you don't get a negative interest rates. So of course you might get price losses, but you like similar to gold, it is helpful when you continue to see a continuous rise in negative yielding debt. So this helps cases for gold or even for Bitcoin. But for us, at least for equity investors, is that the hunt for yield, the hunt for interest rate or dividend yield remains very pervasive and like a starvation of yield globally. So that's why in all our strategy, our dividend yield is a very critical part of us when we select stocks. Okay, this is the PC. So this is probably one of the most important macro indicators out there. And if you had a fortune teller, the one thing you want to ask him about macro is when will inflation come will arrive into the US. So I mean, the blue line basically shows the inflation, the cost, so-called core PCE, which the Fed monitors, and the red line is their target. So in jest, what we're trying to say is please don't cross this, because once you cross this, then cross this significantly, then the Fed will want to raise interest rates faster than we expected. So anyway, the first bullet point, the goal for the Fed right now is they want this blue line to actually moderately be above 2% for some time. I don't want to go into the weeds here, but so long as this is below red line, we can expect interest rates to remain low by the Fed. And what they're guiding is that they don't expect things like maximum employment until 2023. So end of 2020. So 2021, this year, next year, the Fed is not expecting to move rates based on their latest statement. The second goal for the Fed is, I think the difference this time around, they want to see employment. So they're not going to raise rates until they see employment reach back to the 4%. So that is their goal. And the latest comment by the Fed is that the Fed is still in QE mode. I mean, they're still buying bonds until substantial further progress. I don't want to bore everyone on this, but what it basically means no rate hike 2021 or even 2022. And only in end 2023, based on their guidance, they will look into moving rates if it meets their forecasted goals. Okay, the other theme is also supporting global economies and also the global markets is the fiscal stimulus. So like we mentioned, the difference this time around is the handouts. So giving money, putting money in our pocket is more effective than the government cutting tax or of course giving government guarantees. So you can see the blue line here on the chart. This is the amount of stimulus the US government is giving, is record high. So in the global financial crisis, you can see that the stimulus was maybe 9% of GDP, but this time around it's like 16. So it's like they're really just throwing everything to help out the economy. The second bullet point is just saying that even if they don't want to give loans, one way they can stimulate without without hurting their balance sheet, at least the appearance of gearing up is to give government guarantees. In interest of time, I'm not going to go too deep into this. Okay, the last one for the macro themes is that our market is cheap. Of course, when you look at the blue line, you'll be thinking it's not cheap. I mean, the PE, okay, the blue line is the STI PE. So it's 20 times, but because we are taking the PE based on very after all the aggressive earnings cut. So I think the market cut earnings by almost 27%. But if we adjust the PE in the gray line based on pre-COVID levels or even close to pre-COVID levels, the market right now is probably about 11 or 12 times PE. So this is like way low. This is like the bottom of the range for our STI market. And the other, actually, sorry, it's not 40% cut, it's 27% cut. The second bullet point is again, we are 11.5 times. And when we always want to remind everyone that equities, we think is still the best place to put money because you're still at least getting a 4% dividend yield. And this is dividend yield based off retained. And there's also, even after paying you dividend yield, a typical Singapore stock has 50% retained profits. So they're only paying you dividend yield out of 50% of their earnings. So the other 50% is still retained. I know this is a bit academic, but I just wanted to remind everyone that the dividend yield, actually, they can even pay even higher if they wanted to. Okay, I'm going to move on to Weiren. So Weiren will just run through his view on the STI and give you his number one pick amongst all the Singapore stocks based on technicals. Weiren, I hand it over to you.
Okay, thank you, Paul. So I'll be sharing some insights in regard to the STI and where are the key technicals to look out for and determine the next move. So on the following slide, on the slide one, this is really the money chart. So the title suggests that 3,000 is poised to break. So why do I say so? Because yesterday price actually closes at 2,993.19. So it's around 6 points shy of the 3,000 psychological level. So looking back, so we want to see that that 2021, the first ending week has already brought good news already. So like what I mentioned earlier, STI has rose so much at the start of 4th January. So in order to see how the rally is going to sustain in 2021, we'll likely go back in history. So let's go back to 2008, that we can see that the first correction after wave one of the super cycle phase where it peaked at 3,900. So after that, STI has not break new high ever since. As such, the corrective phase has been ongoing for 10 years, starting from the rebound happened at 2009, which is wave A. So if we use wave theory, you can see that the STI has completed corrective wave A in 2009, and then followed by B in 2014, where the rising wedge can be classified as subwave C ending diagonal, which is around 2013 to 2015 era. Okay, the major wave C is yet to complete, which is at 2020. You can see the W or C, the marking over there with a potential grand super cycle wave 2. Reason being why it's not being confirmed is that wave 3 structure is rather complex if you divide it into a subwave count. Okay, so first it started off with an expanded flat where the subwave terminal at last year 2020 low where the COVID settled down. So last year was near 2001, and then it rebounded after that on the second half of next year. So the next three wave may be an impulse sub third wave, or means that the impulse motive wave, third wave or wave X, we do not know. So what clue it offers is that the crucial resistance zone at 3,151 to 3,238 region, which is slightly the second X that is there. So if this resistance is broken, then we can see that the next target will be at 3,500 region, which is the subwave 3 minimum target. So if we pass that, then we can see that 3,007 will be will pass. But however, I think that 3,002 I think will be the maximum what do you call it, space that you region that will go to. All right. So on the next slide, okay, instead of using a double tree or double zigzag to mark out the corrective phase, we employ a 5-wave symmetrical triangle, which is part of the wave theory. So after wave 1 of the super cycle, you can see the A, B, C has been completed of the symmetrical triangle, and then we are pending on wave D. So you can look closely, right? If we are doing the if if you can see that the current up move is potentially the first leg of the D stop D wave. So we are pending on the first move up, and then second move down, and then back to the support zone, and then a last move up to the D zone, the top, which is around 3005. So but normally D wave has a higher tendency to break in expanding and converging type of triangle. So this don't really need much explanation. So I'll be moving on to the next slide where we can see that on the daily chart. So diving into the pattern and wave, I noticed that the fractal nature of the falling wedge has some similarity in movement, ranging from small to big. So let's focus on part whereby wave A or 1 is, and B or 2 is. So that is the sub triple zigzag wave. So if you notice that the sub triple zigzag wave is actually forming a falling wedge, that is one of the largest one. All right. So if we measure the breakout, okay, after since it's breakout, the upside has almost moved 1.35 times in length as compared to the one on A. Okay, so if we measure time 2 of it, it will end up where resistance zone is from 2983 to 3012. So which technically the lower bound has already been broken since yesterday. So I think that next Monday there will be, if the current momentum is moving in accordance where last night the Dow futures and the S&P 500 futures has really moved up higher. So it actually has it might has actually a gap up above the resistance zone actually. So coming back in, if we analyze through the lens of the price action, okay, we can see that the golden cross has already confirmed the bullish upside. So means that the upside will kind of last for the next couple of months or periods, if you like to put it this way. And then the breakaway from the panel on Friday is showing a strong confirmation of a bullish upside. So in summary, you can expect further upside in Q1, but moving on, the monthly resistance remain a strong crucial level to watch in this coming quarter, Q1. So if it breaks, then Q2, back to Q2, we will see what is it. Okay, so the next slide, I have I've put in the Ichimoku indicator. So it has already shown us 3 golden cross already. So it's kindly that it means that like the moving average, the golden cross, Ichimoku has more confirmation, and then it shows that the 3 golden cross is in Japanese, it's called Sanyaku Koten. So it means that the bullish factor is factored in already. So, but I would like to bring you to the fact that if you see that Senko span A is pointing upwards, with the Senko span B is pointing upwards as well. So normally, in normal circumstances in the bullish or bearish market, normally the Senko span A will point to the dominant trend direction, while the B Senko span B is flat. But this time around is pointing upwards already. So if you can look at the range between Senko span A and Senko span B, the range of the cloud is widening. So it is indicating a strong bullish momentum, and this one will be a strong bullish support as well if price is going to retrace. And then the most important thing is the lagging Chico span, which is trending strongly above the candles, and the distance between the candles and the Chico span is actually showing a strong momentum. All right. So also the pattern which is shown earlier in the chart is considered a strong bullish P wave. So it's a continuous. So if you measure up the P wave, it should reach around 3002 region, which I shared during the monthly chart. All right. So the next slide, which is my last slide, is AEM Holdings. So why do I do this as a the top technical picks is because the primary 5th wave has yet to complete. So we have a very strong sub ascendant wave 3. Okay, that's ongoing. And then there is if you look at the weekly chart pattern, the ABC sub ABC corrective pattern, which may be a potentially wave 4, provided it break the resistance zone mentioned over there. So if it rejects, then there'll be a expanded or regular flat kind of corrective flat pattern. Nonetheless, I think price, if there's a correction, there's a rejection, a resistance zone, I think price will correct back to a support zone and then rally up to the wave, to the fifth wave. All right. So with that, I end off my presentation. So should you have any question, please type in the pigeonhole or in the Q&A and then upvote it. All right. Thank you very much and see you later.
Okay, thank you, Warren. So now I'll be starting off with the sector views. First of all, we'll be talking about the banking sector. So just to take a look at the year in review 2020, the main thing to look out for in the graph on the left is definitely the rate cut that happened during March last year. So there was a 150 basis points rate cut in March by the Federal Reserve to cope with the ongoing pandemic previously at March. So what happened immediately, you can see on the left-hand side is that our Singapore interest rates, the SIBOR and the SOR fell, and the average NIM of our banks itself fell through to the bottoms that were last seen even around 2013 to 2014 level. And this is what hurt the banks pretty much most of it in 2020. And moving on, you can see that as the pandemic rages on, as different economies started to shut down, we saw that credit costs had to be heightened as well because the banks started taking some preemptive provisioning because businesses were not allowed to operate as normal, as usual. And furthermore, there was a dividend cap that was implemented by MAS on the banks itself. So these three factors actually hurt the banks in 2020. And we also saw that this was coupled with weak loans growth. However, on the other side of the capital markets, we saw that the volatility-wise, it actually benefited SGX with a lot of market participation. When prices actually crashed, and we saw that everybody just started coming in to buy stocks and buy all kinds of investment products on the market because they were much cheaper right now. So moving on, next slide. As we head into 2021, I know a lot of people will be quite curious because right now we see that the banks have already rallied a lot in terms of their prices. And for us as well, we are still holding a neutral call in the banking sector. However, we are kind of waiting out on a few re-rating catalysts. So on the right-hand side, you can see, first of all, the loan moratoriums have already, in Singapore, the first phase of it has already expired as of 31st of December. So in the upcoming earnings results, what we are looking out for the banks itself is whether the banks are comfortable to come out and say that, hey, you know what, the credit costs that we have provided for are sufficient, and we will be further tapering the credit costs, and this will be a huge boost in earnings in 2021 and result in a re-rating of the entire sector. Secondly, there will be a lift. There is likely to be a lift in dividend cap in our point of view by May. What happens is that it should resume back. Once MAS is able to lift this dividend cap, the yield will come back for the banks itself. Previously, they were trading at 5 to 6%, and if they are currently they are trading at about 3 to 3.5%. So this will also be something that will be attractive to investors who are going back into banking stocks. There is a possible for loan upticks as well as economies start to recover, because during the entire year of 2020, while we were expecting a very low loans growth, loans actually went negative for the entire year of 2020. And that was something that was out of our expectations previously. And in terms of market participation, capital markets activity is slightly to taper off. Ultimately, it is hard to beat the high levels of activity that we have that we have seen in 2020 itself. For the recommendation within the sector, we are preferring SGX, which I will be talking about it later during the accumulate and buy calls. But for banking sector, for the bank's exposure, we currently prefer UOB, although we have a neutral call on it due to the current lift in share prices. But generally, what we are expecting for UOB is that they are a little bit more defensive compared to OCBC and DBS, having a more ASEAN exposure. And if you look at the past, if you look at the past 1 year, what they have been coming up with is that their specific provisions are much lower than their peers, and this will probably see them recover at a faster pace when the economic conditions recovers. So next, next. Okay, so next I'll be talking about the healthcare sector. When we take a look back at 2020, similar disruptions by COVID-19 as well. I think all industries were affected the same way. But we can see on the chart on the left-hand side, for public, private hospitals, specialist outpatient visitations, dental clinics, all fell to kind of multi-year lows. If you compare it, the chart on the left, all along you can see it's a very stable, probably single-digit growth year on year. However, when COVID hits at the peak, dental clinic visitations was down 80%. That was how bad it was hurt. And I think generally it was because of the aversion to healthcare facilities, because at the point in time when nothing much was known about the virus itself, people were just afraid of contracting the viruses in various healthcare facilities. Then secondly, we see that the travel restrictions that hit the medical tourism and supply chain alike in Singapore. So the entire supply chain for healthcare was hit particularly bad in 2020. However, we also saw that a handful of winners emerged. We saw that medical PPE manufacturers, such as glove manufacturers, overalls manufacturers, they kind of they saw their earnings kind of skyrocketed because of the nature of their products that they were manufacturing. And then we have COVID-19 test kit distributors that kind of benefited from the situation. No, it's not very nice to say this, but yes, so what happened is that because of the sudden demand for these kind of new products out in the market, they benefited from it. And next. And heading into 2021, okay, we are expecting a very healthy recovery to come into the healthcare sector. And if you look at the graph on the left-hand side, actually zoomed in on just the past 1 year of healthcare demand over the various medical facilities. We can see that actually public healthcare recovered first. They weren't hit the most as well, but because that is not investable for us, right? We take a look at the private hospital, the specialists, and the dental. We actually see that what is interesting thing is that the specialists themselves, they are already past back to their pre-COVID-19 levels and even growing, although it's a 1% year-on-year level, but it's still we notice that there's a pent-up demand for such medical services. I think during this period, as people become more comfortable with the virus around, and we are controlling the situation pretty well in Singapore. Secondly, we see that telemedicine has already started gaining traction, and the development phase that they face during the COVID-19 period actually will probably help to accelerate them in managing their efficiencies within the sector itself. And thirdly, because of how Singapore has managed our COVID-19 situation, we are expecting there might be possible recovery in medical tourism as we open up our borders. You know, ultimately we are more concerned with the local spread. And so if we, I mean, currently it is still a hassle for foreign patients to come into Singapore, because I think doctors will have to get approval from MOH itself. But if we actually relax these stringent rules, then we may see some people returning to Singapore for treatments. And then lastly, for the last point, for the outlook itself, we think that the demand for medical PPE and test kits are likely to normalize. So for the sector itself, we actually upgrade the entire healthcare sector to accumulate. I think generally exiting COVID pandemic situation, normal operations and operational environment will benefit the sector as a whole. And our top picks for the sector includes IX Biopharma and UG Healthcare, which we will talk about it later in detail. And that's it from me. I'll now hand the time over to Terence, who will be talking about the utility sector.
Thanks, Wong, and good morning, everyone. For 2020, as with most other things, the utility sector, which is an important indicator of economic performance, was negatively impacted by COVID-19. But two key markets, China and India, has seen a recovery, which is positive. We provided a chart on the top left-hand side. You can see this on the top left. We show India production. here. And you can see India production really falling very sharply in the first half of 2020, but subsequently picking up in the second half of 2020, just very slightly, but it's shown green shoots in terms of picking up. For the fourth quarter, this remained lackluster though, mainly due to the resurgence of COVID-19 in terms of how the Indian government has tried to control COVID-19 and the response towards COVID-19. But this hasn't been as effective as we had hoped. So all these efforts really impacted the economic reopening efforts in India. Although there are improvements, again, very slightly, we see plant load factors, which are really the utilization rate of these power plants really improving just marginally from 50 to 52% in June to an average about 55% in the fourth quarter. China's economic activity, however, rebounded very strongly in the fourth quarter, especially in the second half rather. And fourth quarter expansion also continued. We've provided a chart on the left-hand side again. China electricity consumption. You can see China electricity consumption falling very sharply in first half 2020, but also rebounding very sharply subsequently for second half 2020. We see output growth in China and retail sales growth in China also rebounding very strongly. And this is a huge boost to economic growth in these economies. Plant load factors are also up to about 68% from 55 to 60% in June. So they've effectively controlled the virus, and the economic activity is really rebounding very strongly in China, which is really a bright spot. In our next slide, for 2021, we expect economic activity to continue improving for 2021, which will boost the utility sector because of power demand increase. China's economic outlook has already been upgraded, with GDP now expected at about 8% in 2021 from 7.7% previously, which is a positive. This especially when almost all other major economies are still expecting negative growth. So this is quite remarkable. India's growth is also expected for 2021, but we expect the growth to be weak in the first half of 2021 because of the high amount of COVID-19 cases. You can see this on the chart on your left. We provided this chart here. You can see the number of COVID-19 cases really spiking up. Sorry, it's a little bit blurred here. You can see the COVID-19 cases really spiking up in September and October, which is the third quarter of 2020. But they've subsequently managed to pull this down a little bit. But that said, even though they managed to reduce the number of COVID-19 cases, it's still averaging about 20,000 cases a day. So this will present a challenge in the economic front. But the positive thing we see about this is that India has rolled out some vaccines, and this could be positive for them in 2021. For our stock picks recommendation, we favor Sembcorp Industries in this sector, but we downgrade the counter to neutral for now, as this has already exceeded our target price of $1.75. In our next slide, we provide a summary of the marine sector in 2020, which bore the brunt of COVID-19. As with all other sectors, one of the most pronounced impact for the marine sector was oil prices turning negative for the first time in history in April 2020. So it actually dipped below $0. So what that actually means is that in order for producers to clear this stock, they actually have to pay some of the barges to clear the stocks for them. So that's why it turned negative. Of course, it recovered subsequently, but it has stayed weak due to, we think, because of two main factors. Because of on the demand front, weak economic activity due to the worldwide lockdowns, which really curtailed transportation all around the world, and a lack of deal within OPEC. Because they're having some disagreements in terms of output cuts. So the supply, they haven't been able to fix the output from the supply front. Also, all these have a huge impact on the oil prices as well. So in view of the weaker oil prices, you can see that most of the oil majors have really slashed capex in capital expenditure in anticipation of a prolonged downturn. More than 50 oil and gas firms have filed for bankruptcy this year because of the weak oil prices, and upstream capex have been cut by 22%. You can see here for this chart on the left-hand side, you can see that the oil majors, you can see it's about 10-year chart. You can see all the oil majors capex have been falling over the years because of weak oil prices. And you can look, we've also provided Keppel, O&M and Sembcorp Marine's order book. And you can see the order book has really fallen very, very drastically over the years. So what's our outlook for 2021? In our next slide, we see a slight improvement in the oil and gas sector activity in the fourth quarter of 2020, which is a positive for 2021. For 2021, we still do expect the outlook for the marine sector to remain weak because of oil prices. According to the EIA, oil prices are expected to average US $49 per barrel in 2021. This is versus the $55 per barrel that they projected in 2020. So you can see that there's already a downward revision in terms of the expectation for oil prices. And we also think that the economic outlook will be expected to be affected by the pace of economies opening up. We think that the pace of opening up may take a bit longer than expected, and so that will again will in fact affect the oil prices. All in all, oil majors capital expenditure is expected to be about 11% lower versus 2020. And you can see here on for the chart on your left hand side, the international rig counts have also fallen quite sharply over the years, and is now only 669 rigs are operating. And this is important indicator, because when you have only 669 rigs operating, it means that drilling activity is really down. What that means is that they are really expecting output and demand to remain weak. And for 2021, this will likely continue to be weak. Our title here is Uncertain Outlook Prompts Action, because precisely because of the weak outlook, we do think that this will prompt action for Keppel and Sembcorp Marine. There's a strategic review that's ongoing now on Keppel and Sembcorp Marine, and we think a deal is more likely to happen than not because of the uncertain economic outlook. We'll be providing more. We'll provide more details on this when we talk about Keppel later. So in this sector, then we prefer Keppel Corp. We have a buy call on Keppel with a target price of $6.12. So that's all from me on the marine sector. I'll now hand over to Natalie, who will cover the property and REIT sector. Over to you, Natalie.
Thank you, Terence. So now we'll go into the property sector. As seen from the graph on the left, property prices inched higher in 2020, lifted by non-land prices in the rest of Central region, which is the grey line you see in the graph. So year to date, for the first 9 months of 2020, residential prices increased by 2.2%. This compares to the 2.7% increase in 2019. Moving on to the graph on the right, despite closure of show flats during the circuit breaker period, transaction volumes in the private residential market continue to be robust, with primary sales for the first 10 months reaching 8,300 units, a marginal 7% decline year on year. Full year transactions will likely come in above our volume estimates of 9,000 units. Meanwhile, almost 8,000 units transacted in the resale market for the first 10 months of 2020 was 6.8% higher year on year. Next slide, please. So in the chart on the left, we see that the overhang in unsold units has fallen from the peak of 37,000 units in 1Q 2019 to 26,000 units as at 3Q 2020. Moving on to the right, demand has kept pace despite the absence of foreign buyers during the most part of 2020. Developers launched 15% fewer units in the first 9 months of 2020 than in 2019. But about 7,300 units were sold during the first 9 months of both years. So the take-up rate for the 9 months in 2020 was 94% versus 80% in the 9 months of 2019. Next slide, please. So moving on to the outlook for the property sector, for 2021, we are expecting residential prices to be mildly positive in the range of 3 to 5%, with transaction volumes expected to come in around 9,000 units. There are several factors supporting the property market in our view. First, the private housing market is an indirect beneficiary of the BTO construction delays and resale grants. New families may be inclined to tap the resale markets instead of waiting for the 5 to 6 years for BTO. This will allow HDB sellers to monetize their homes with greater ease, upgrading to private housing should they wish to do so. Secondly, there are some 25,000 HDB units that will achieve MOP, minimum occupancy period, in 2021. The lower interest rate environment and attractive and reasonably priced products may turn HDB owners to upgraders. Thirdly, in the chart on the top, we see that the government has kept the new supply of low. So the government land sales, GLS, for the first half of 2021 is slightly higher at 7,000 units compared to the average of 6,500 units over the last four halves. But this is still within the lower range, as you can see. Majority of the supply is on the reserve list, which is the dark blue part of the graph, and only 23% are on the confirmed list. Majority of the supply is on the reserve list, which is the red portion of the graph. Only 23% are on the confirmed list. Lastly, in the bottom graph, we see that Singaporean families are increasingly better capitalized. The loan-to-value ratio, LTV, has fallen from 53% to 49% over the past 2 years, and in fact improved by 0.3 percentage points quarter on quarter in 3Q 2020. However, we may see more property cooling measures to come as the government is concerned about property prices rising too quickly. So next we'll move into the REIT sector. So starting with the graph on the left, year to date, total returns for the S-REITs was down by 3.6%. So this is an outperformance over the STI, which fell by 8.1%, and over the developer index, which fell by 16.1%. So moving on to the graph on the right, dividend yield spread over the 10-year bond yield was at 3.4%. And this is close to the historical yield spread, historical average yield spread, which is the red line that you see in the graph. This is a more attractive entry compared to where REITs were trading in 2018 and 2019, which was below the -1 standard deviation, the lower green line you see in the graph. So the price recovery and low interest rates make acquisitions more accretive for the REITs, and we will likely see more acquisition from the REITs. Many of them will be able to reap interest rate savings from refinancing maturing loans at lower rates. The next slide, please. So this slide shows the recovery by subsector, and I'll give a quick review of the year by subsector. Drawing your attention to the table at the bottom, at the trough, REITs suffered a maximum drawdown between 28 to 55%. Industrials and healthcare were the first to recover. By June, they were trading close to their pre-COVID levels. These two sectors faced the least business disruption as tenants required less help by way of rental rebates. About 70 to 90% of tenants in high-spec logistics and factory assets were operating within the essential services sectors, and they were able to operate on premise during the circuit breaker period. Business parks had lower physical occupancies, but companies in business parks were able to implement telecommuting. So straddled in the middle are the retail and office and diversified sectors. These sectors were limited by the containment measures in phase 2. So malls and F&B tenants were operating under capacity restrictions, while office tenants were left to refine the implementation of their remote working and evaluate the importance of their office in their operating structure. So the retail sector faced the most uncertainty and remained depressed due to the rolling resurgence of COVID-19 cases globally and the poor clarity on the vaccine timeline. Prices started to recover in November after countries began announcing approvals and rollout of vaccines, which provided a visible timeline to recovery. Next slide, please. I'll go into the respective subsectors. So starting off with retail, we are overweight on the retail sector. Drawing your attention to the graph, we can see that both rents and occupancy were down in 2020. Central rents showed more weakness. So central rents actually fell by 10.2% for year-on-year in 3Q 2020, while fringe rents fell by 4.4%. Occupancy was down by 2.1 percentage points. Okay. So we are overweight because the retail sector will benefit from further reopening in phase 3. which entails the increase of group size from 5 to 8, as well as more people returning to office will help the central malls. Suburban malls, they will benefit from increased daytime population on a more permanent basis due to the permanent hybrid working arrangements that firms have been rolling out. So we believe that dominant, well-located and managed malls will be prioritized amidst the retail consolidation. Dominant malls are those that are located near transportation nodes, and a lot of our REITs actually hold these well-located malls. So landlords have offered leases with higher variable rent components for some tenants. So this might actually result in lower or more uncertain revenues moving forward. In terms of retail sales index, it was down by about 3.1% year-on-year in November 2020. We expect landlords, we may see some declining rents in 2021 as landlords will prioritize occupancy over rents. Moving on to the next slide. We have the office subsector. So for the office subsector, starting off with the bullet points, we see structural decline and weakness leading to a challenging leasing environment. For this reason, we are actually neutral on the office sector. So permanent hybrid work arrangements will set in motion more aggressive right sizing in the midterm. And already we have heard feedback from the REITs that tenants who have maturing leases, some of them have elected to give back or renew less space by about 10 to 30% of space. So we may see more demand from co-working operators as flexible space could be used as an interim strategy. However, on the positive note, supply, we can expect more supply to be taken offline. So as you can see, the graph on the left, this is the blue bars here actually show the supply that will be coming onto the market. And already we have CDL as well as Perennial. They will be taking off 3 assets from the market, which are AXA Tower, Fuji Xerox Tower, as well as Central Malls over 2021 and 2022. So this amount of supply, about 1.2 million square feet of space, will be removed from the market. So basically eliminating the first 2 towers, 0.9 and 0.7 respectively, almost wiping them out completely. So the reduction in supply and potential and more developers who may consider tapping this CBD incentive scheme will remove some of the office stock as well as help the office supply, help the office sector sort of reach an equilibrium. However, in the longer term, Singapore does remain an attractive location for overseas tenants who may consider relocating their regional headquarters in Singapore. So this is all for the office subsector. Moving on to the industrial subsector. So there's no graph here, but I'll just briefly talk about how the rents have been performing. For the overall market for 3Q 2020, the rental index was down by about 1.6%. Across all subsectors, we saw declining rents. However, occupancy was up very, very slightly by 0.3 percentage points. And this was largely due to the warehouse asset class, where there was a higher amount of take up in space due to, in the first half, it was due to stockpiling. And then in the second half, we saw more demand from third-party logistic players. So that actually helped to lift occupancy for the industrial sector, as well as some take up in a business park space. So the outlook for the industrial sector is sort of mixed. For data centers, high spec and business park assets, the outlook remains favorable and is supported by the technology, biomedical and precision engineering sectors, as well as limited supply coming onto the market. So if I draw your attention to the graph on the left, we see that the green and red and dark blue portions, which are the business parks, as well as the warehouses and the high-tech spaces, the supply is relatively low. So that will help support the rents. So warehouses may also benefit from higher demand from third-party logistics players. As you know, the percentage of sales, online sales has actually increased, or rather it doubled post-COVID-19 on a normalized basis. So that might actually support the demand for more space by 3PLs. For the factory asset class, we think that the leasing or the environment will be more challenging as as the global demand is still recovering, and the sector is also, this asset class is also faced with considerably more supply that will hit the market, which is denoted by the light blue bars in the graph. So we are neutral on the industrial subsector. Next slide, please. So this is our last sector for the REITs. It's the hospitality sector, and we are overweight on this sector. So I will explain why shortly. First of all, just drawing your attention to the graph on the left, we see that while the international borders remain largely closed, visitor arrivals is still down by about 99%. However, due to the reopening and the allowance, or rather towards the festive season at the end of the year, we see that the RevPAR has sort of picked up. So the outlook for the hospitality sector, we think that the future business travel will be more targeted and less frequent. Some business trips may actually be swapped out for virtual meetings instead. MICE demand, however, will remain strong as certain elements of business engagement as well as networking are difficult to replicate virtually. COVID-19 also set historical lows for the hospitality sector, so this may result in lower minimum rent in future lease negotiations. Already we have seen this in some of the lease negotiations with escort residents. More on that later. And COVID-19 was also a digital push, so we saw a lot of hospitality REITs actually reporting that they have adopted digital technology solutions, and this has resulted in a leaner operating cost for the REITs. There will be a pent-up demand for leisure travel. However, that's it. We think that the borders will remain largely closed at least for the first half of 2021, with the domestic travel borders being opened up first. So because of that, countries with sizable domestic travel markets will be the first to recover, and some of these markets include China, France, Japan, US, UK, Australia, etc. So that's all for me. I'll pass the time on back to Paul.
Okay, thank you, Natalie. So I'll move on to the consumer sector. So in summary, the chart basically tells you that I should have been selling groceries last year. So the blue chart shows the growth in grocery sales in 2020. So it rose as high as 60%. The yellow chart basically is the red chart. The red line is the retail sales, so it's still weak. I think the most recent number was down 3%. The most recent November number. And other eating places means like you're eating at the food courts and so forth. So that is also still down. But the story for 2020 was grocery sales. And even when we looked at the most recent November number, grocery sales or supermarket sales was still up 22%. So if you take that into context, how supermarket sales were trending in the last 5 years, which is, you can see in the middle, the 1.3%. So basically groceries are still rising like 22 times faster than historical trend. And I think based on that, I think Sheng Siong numbers could surprise on the upside. I mean, based on the latest data points that we're getting on sales. But from a top-down perspective, some of the headwinds that's facing consumer will be the income is down for this year, the latest numbers, and also employment, is at 3.6 million is the 7-year low. I mean, the number of people employment, this is not unemployment rate. So there are still headwinds being faced by consumers for this sector. But the one that's positive is groceries, and it seems to be still trending far above the usual 1.3% trend rate. A quick flash on construction. We don't cover it at the moment, but you can see that what has happened is what is happening on the ground now is a worker shortage, and even if you have workers, they all have to work in shifts. So in the past, maybe I'm just giving you an example. In the past, maybe the worker could paint and the other one could tile, but right now you have to the workers have to tile first, then after that they have to leave the premise, then the painters have to come in. So all this is going to delay construction activity, and that's why even the HDB, the BTOs will all be delayed. And from this chart, you can see that the amount of contracts, the amount of contracts awarded by the public and private sector is it's a multi-year low. I mean, although it's a 2017 low, but you can see 2017 is almost like a 10-year low. So, but we expect it to rebound, and a lot of the projects actually have not been cancelled. I mean, maybe the T5 have been, shrunk a little bit, but a lot of it has been deferred. And so, but like we always mention, if you still want to play construction, the best way to get it is through the building materials, because most of these guys have, I don't know, 40% market share, some 70 to 80% market share, which is not your BRCs or Pan United. Okay, we don't cover STE, but I guess this chart kind of can help us summarize the outlook for ST Engineering. So you can see that the revenue for ST Engineering is in red. So it trends quite closely to the blue line. So the blue line is the Singapore government, the defense budget. So the good thing in summary for ST Engineering is somebody's got your back. So the defense spending is growing about 3% CAGR, and then ST Engineering's revenue about 3.6%. So it's a very stable growth because because of all the defense funding by the authorities. This year, the first bullet point, the revenue will be hurt because of commercial aircraft, because they do servicing 4% year. So it's all about this. In summary, this talk is about stability. Okay, telcos. I've got 2 slides here because we got quite a bit of questions on telcos. Okay, the problem for Singtel, why it did so badly is the first, again, you can see from this chart, it's quite evident. The first half, there's like 90, almost 86% decline in profits. It's almost like an airline stock in a way. It's like down 86%, but it's not, it's a telco. So Optus, the problem for Optus was broadband margins collapse. I think because they used to own their own network, and then now the government kind of, everything has to be farmed out to the government. So for telcos, the other one is associate. So we are lucky later, after this call, our analyst from India will be coming in to talk about Bharti. And I told him to also, because we're not familiar, especially me, although the telco analyst, but anyway, we're not very familiar about India, so he was going to give us a bit of background. So do stay tuned for that after our presentation. He will give you a rough what has happened and how the evolution of the Indian telco sector. Okay, then the other polar point, just wanted to tell you that on 5G, don't expect much. I mean, even the telco say they want to roll out 5G slowly. So when the telco tell you roll out slowly means don't keep your hopes too high on whether and on 5G helping to boost revenues. Okay, there is some positives. I think for us it will be the valuations. I think because the share prices have dropped quite so much, I think the valuations are starting to turn positive. And one thing about this chart that we see here, like an airline collapse chart for Optus. No, Optus is just a reminder, Optus is owned by Singtel, their Australian operations. Is that the NBN, the reason why it's so weak because the cost is very heavy. Although they lost this business, they are still keeping the cost. But this thing is starting to dwindle down, and then there's a chance that they can cut off, remove a lot of costs from their legacy broadband business. So the reason for this is because the broadband business, in a way, taken by the government, run by the government now, and then, but they still have the broadband cost. So once they remove that, then you can see things start to turn around. So our rating is neutral. We always show this chart, but just to refresh again, the reason why telcos are so bad is the third quarter number. You can see this is basically the ARPU, the prices that all of us pay. Maybe too much, but all of us pay our mobile bill. So this is basically the average person that pays a mobile bill. It used to be $80, 75. So those were the happy days. It was best to run a telco then because there was virtually no competition. So the happy days was 2008 to 2016. Then when TPG came on board, I think it's very obvious everyone started to slash prices ahead of TPG. And then we also thought there'll be stability. So we were actually quite bullish on telcos. But then when the roaming impact hit, because roaming, when we inbound, that means people who come in, and outbound, whenever we leave the country, we pay roaming charges. So that is actually high margin, and it's almost like 20% of mobile revenues. So that virtually disappeared, because international borders are shut. So that kind of hurts, and you can see that's why the ARPUs are down. So since 2017, you can see that there's a free fall in prices. If you want to monitor when can roaming come back, I think the two big countries for roaming, at least for us roaming out or roaming in is Malaysia and China. So if these two countries kind of like, if we have free flow of traffic between these two countries, you can more or less say that the moving revenue issue can rebound quite strongly. I mean, roughly, of course, there are many other countries, but these are the two key countries. Okay, aviation, yeah, this is a bit of a set chart to see, but I mean, if you want to calculate this 99.9% drop. Okay, so in November, SIA, just to reference to the chart, in November, SIA carried about 45,000 passengers, so about 1,005. A year ago, it was about 1.92 million. So a bit, so obviously very sad, and the number of passengers is just is down drastically. So we expect, like Natalie said, a very gradual rebound for aviation. The worry we have for aviation is that the competition has not abated. I think most of the airlines, because these are state-owned, are still around, and even when we leave and borders open, the competition will still be, especially the Middle Eastern airlines. And the other thing is that these airlines are more leveraged than before, pre-COVID levels. So before before COVID, the sector was really very challenged. Post-COVID, still challenged, and then now you have more leverage. So it's like almost like a double whammy kind of thing. Okay, in terms of the book value, we had some very good questions in some of our seminars earlier about the actual book value. So based on we think that historically the book value has been around 0.7 to 1.7 with an average of 1.1. So right now, although on paper the book is 0.8, if you adjust it for the MCBs, the book value is actually about 3.6 times. I think I need to rush. We are actually running short of time. Okay, for transportation, is for taxis, I think it's still down about 20%, but we are expecting more activity and as a work from home kind of routes. Okay, this is one chart, although we don't call containers since NOL was delisted, but this is like the container rates become turn rocket ship. So this is the container rates. So this is the average cost to ship from Shanghai to LA, ship from Shanghai to Europe. But you can see recently there's been a big spike. So this is almost like a girl sector kind of spike. So what has happened is that not everyone is shifting to more goods. There have been more imports into the US. Consumer spending shift to more goods. And we think maybe the next wave is possibly ship orders. So this may be positive for Yang Zhejiang, because once all these rates rise, then all these ship owners will want to order more ships. Then the other thing is the shortage of containers. I won't dwell too much in view of time. Let me move on. Okay, for the tech sector, we are still positive. I think tech sector will be a multi-year of growth. This year, semiconductor sales were up 6%, and you just remember this is supposed to be the worst global recession. Cloud capex, because work from home, a lot more spending on cloud. Okay, this chart basically tells us that there's going to be a lot of electrification of cars. There'll be a big jump from 2020 to 2022 is the doubling. We're not saying that these cars are battery cars. Okay? It's not like Tesla. They're going to see like every car will be a Tesla. But what it means is because in Europe, the mobility standards will need them to raise. So these are like mild EVs and mild hybrids, which is the blue color, and EVs, plug-in hybrids. Because in order to meet the very tight emission standards, a lot of cars have to move into either EVs, or you have to raise the electric. You have to turn it to like a mild EV to meet the very tight electric standards. The other thing driving for autos is automated driving. So basically, hands-free. Then the one that I want to use the next time the car will be brain-free. You don't have to think about it, or vision-free as well. So these are L2, L3 cars. But okay, but the key thing is whenever you move into electrification of cars, the chip content per car will actually jump 44% if it's a mild hybrid. But it will double. That means, let's say maybe $10 a semiconductor. Actually $40, about $40 it will turn to $100. So not only will the number of cars rise, but the amount of content in the chips will also rise. So that's why it's very positive for the tech sector. And of course, we have other things, 5G memory segment. Okay, so we have like 40 minutes. So we're just going to run through all our stock buys, and hopefully all of them actually hit the dot. If they don't, look for the other analysts. Okay, so we always have a model portfolio. So this is our model portfolio. In part, it's not about showing the performance, but for us, it's also to give transparency, so that we're not going to tell you, oh, this is our top pick, but we don't tell you how we actually perform. So the table on the right is the performance. we were flat last year. I think, again, this is just for illustration. You may or may not get this number because we basically it's a 10 percentage points for each stock and we rebalance it every month. And, but of course, we don't take into account the dividend from this and we don't take into account the rebalancing cost. But again, just for illustration, we were flat, and of course, although outperform doesn't pay any bills when you don't generate any profit. But anyway, our new addition is Escort, which Natalie will elaborate later, and Keppel Corp. So these are our top 10 stock picks. The only small cap, we rarely put small cap. We try to put a lot of the large cap. The only small cap we have here is like Asian Pay TV and Propnex. So this is the only small cap. Otherwise, we typically don't put the smaller cap names. Okay, let me start off with Asian Pay TV. Obviously, the stock hasn't performed, and maybe that's why a lot of people don't take my phone calls when I talk about Asian Pay TV. But Asian Pay TV is a monopoly cable TV provider. So one of the reasons we like it, there's two reasons here, is because in the past, they cut their dividends very aggressively, but this time around, we think the dividends are stable and that the 8.8% yield is maintainable because we think they will generate 50 million free cash flow, but the dividend to hit the 8.8% is only 18 million. The table on the left is just to show you that although cable TV subscribers are down, but it's being offset by broadband subscribers. So that's why the combination of cable and broadband, you can see that the number of subscribers is still stable. These were the good times, but then since then it's been stable. So we're not expecting a high growth, but we just want to collect the 8.8% yield, and that's why we like the stock. And the other thing will be, like we mentioned before, when 5G is being aggressively rolled out in Taiwan, because everyone paid, I think, too much for their license fee in Taiwan, but because of that, they will need to rely on third-party fiber, and Asian Pay TV has already rolled out all the fiber. So to connect all the base stations, you need the fiber, and rather than build themselves, which they probably have no budget for, and rather than take from the competitor Zhonghua, most of the telcos we think will start to use Asian Pay TV, and this will give another extra revenue stream, which is not into the 50 million that you see here. ComfortDelGro. Okay, so for ComfortDelGro, our rationale for buying is that the stock is down 30% from pre-COVID levels, and despite the weak year, they actually generated almost 300 million of operating cash flows, and also they're back to net cash position. So basically, so unlike like SIA, where pre-COVID, post-COVID, the balance sheet is even more damaged. But for Comfort, actually, post-COVID is even better, the balance sheet. And basically, this is our stock is a way to pay the recovery in Singapore, a recovery in activity. And we also like because they have a 60% market share. But of course, we are this is not going to be like a 2-year or 5-year view on this stock, because Grab is still a very formidable competitor, especially if you have a competitor that's willing and able to lose money. And also the fleet, when we look at the competition, is in our report, but if you look at the competitive dynamics, the fleet, the number of private hire vehicles is actually rising fast. It's still very high it's still rising compared to the number of taxis. So the competition is still intensive for the taxi sector. Again, very sorry if I'm rushing this. Okay, so for Propnex, why a couple of reasons why you like it. Number one is because they got 50% share. I mean, you can't find many businesses in Singapore with 15% share, privately owned, I guess. Then the other thing is they got a ROE of 28% unleveraged, and their net cash is a huge 93 million, which is for a small cap, right? Like half of it is like 30-40% is all cash. And also they have a sustainable yield of 5. We have got a feeling that they might actually raise the dividend because they wanted to keep as a dividend yield stock. In terms of the volume this year, all we can say is that in December, UOL sold 400 units of their development. This is not the typical phase one, launch 10 units and then you sell 6 or 7. This one is they sold almost all 70% of it in just one day. So I think that moving into 2021, property launches will be quite robust. Just judging on one data point, of course, this is probably a sample size error here, but so far as we go to 2021, it looks very robust property sales. Okay, for Thai beverage, we like it because again the huge 90% market share spirits, and this year even though there was a ban in drinking in Thailand in April to May, they still managed to keep earnings stable. And what they did was they just slashed costs. they did, as I see the second bullet point here, they cut like 180 million in terms of marketing. I wouldn't want to be in the department, but actually they cut almost 180 million of their budget. And for me, it was just impressive in the sense that they're willing to aggressively slash costs just to cope with the environment and to keep profits. So at least they're very cost disciplined. And as a reminder, they generate almost 1.4 billion Singapore of free cash flow. So it's a very highly cash generative business and it's a consumer. So we just pegging it to their historical 18 times PE. That's how we got our rating buy and target price. Okay, move on to UG. Okay, I know everyone's going to ask me UG. Okay, so for UG, I can just tell you that even in January, February, ASPs are still rising. So the fundamentals are still very healthy. Of course, the problem we have now is the vaccination, the news flow is negative, and that's punishing the stock. So the first bullet point is that demand for gloves was growing. Even pre-COVID, now they were growing. You can see from the chart here for the last 5 years, almost 11%. And the penetration that they are in the Brazil, China is only like 10. So the penetration is low. Okay, the fourth bullet point, one scenario that might happen is that post-vaccine, even after we vaccine, COVID will still be around. So what it means is that you will still have a lot of testing. The awareness and the use of PPE will still be high. Number one, we're not sure how long the vaccination will last. So it may actually mean we need to get vaccinated. I do not know, okay, I'm not a doctor, but you might need to be continuously vaccinated. And also remember, no, the effectiveness is only 90%. There's still that 10%. So what we try to say is that this year, next year, high chance COVID will still be prevalent and they will still need a lot of PPE to contain this. So the high prices that we see in gloves could eat. I mean, the industry says that they might even last until this year. I mean, yeah. So, but for us, we are taking the 135 based on 2022 earnings. So we actually, this year will be strong. So how we take our forecast is that there'll be like a 20% collapse in prices. Then we use that as a way to benchmark to the prices, to our target price, sorry. No, I'm speaking very fast, but I will move on to the next speaker, Jie Hui on Yoma strategic. Jie Hui.
Okay, thanks, Paul. So just a very brief intro. Yoma is a conglomerate in Myanmar. We like the longer term outlook of Yoma because Yoma is entrenched in Myanmar's fast growing and attractive consumer segments. The property business is the biggest contributor to Yoma's revenue stream. So starting with property, it has a large land bank equivalent to 10 to 15 years of sale. The projects in the pipeline includes Yoma Central, Pangwa Estate, and Star City. In FY21 going to FY22, we are looking forward to the completion of Yoma Central and Star Hub. So especially in the case of Yoma Central, we are expecting it to generate about 100 million worth of revenue, which is equivalent to a full year revenue for Yoma, or recurring revenue. Yeah. And next we have financial services. So financial services are also poised for growth through its key driver, Wave Money. Just a bit of background, Wave Money became profitable within 2 years of inception. In the recent fiscal year, Wave Money actually saw its net profit double on a year-on-year basis. Around mid-October, Yoma actually acquired more stake in Wave, increasing its stake from 34% to 44%. So coupled with Ant's expertise in fintech, we remain optimistic about Wave because of 2 reasons. Firstly, we can potentially expect more revenue coming from Wave, and then also there are abundant opportunities for Wave Money to be integrated into Yoma's business lines. Amidst COVID-19, the F&B restaurants were hit due to the lack of dine-ins, but this is partially cushioned by delivery sales. Additionally, the top line of this coming fiscal year is expected to be held up by unrecognized revenue from Yoma Land and Yoma Motors. Yoma Land has about 27 million worth of unrecognized revenue from ongoing projects, and Yoma Motors has about 10 million from units sold pending recognition. These backlogs will contribute about 33% to FY21's top line. And lastly, we have to keep in mind that Ayala is still targeting to complete the second tranche of its investment, amounting to 46 million at 45 cents per share. This will be done within the next 6 months. And our sum of the parts derived target price actually is a target price of 46 cents, sorry. Yeah, and this provides a 58% upside. Yeah, therefore, we do find current valuations attractive and we maintain a buy rating for it. Next, please. Okay, so next we have First Sponsor. So just a very brief intro. First Sponsor is a developer, financier, and owner of property projects. Its key revenue contributor comes from property development, and its main operations are in China. So the main thing to in China and Europe, sorry. So the main thing to note for the property development segment is that Dongguan, the key market that First Sponsor operates in, saw high demand for its properties such that most of its residential projects are sold out shortly after launch. So as Paul mentioned earlier, interested buyers actually had to pay money to queue up to purchase, to queue up to purchase the properties. So as a result, it owns close to 600 million worth of revenue that has yet to be recognized, and also its existing projects actually provide for a gross development value of almost 2 billion, which is worth 5 to 6 years of sale. In addition, the Human Transit-Oriented Development Project is one of First Sponsor's largest development project, and First Sponsor owns a 17% stake in this joint venture. The construction for Sector 1 will commence in the second half of 2021 and will bring in about 220 million worth of gross development value upon handover in 2022 or 2023. So once developed, this site will become a high-speed hub, which will allow for travel to Shenzhen and Hong Kong within a span of 20 to 40 minutes, which will be very, very, very beneficial for the Dongguan projects that First Sponsor has. So lastly, we do like the high recurring income from the property financing business. The property financing business is actually the most profitable business amongst all its business lines, and the loan book is still growing. The double-digit growth in the loan book is largely attributable to the high demand for credit amongst the SMEs, and these loans are charged at low to mid-teens interest rate. A key risk that we see will be with the hotel portfolio. Avicii's hotels are located in the parts of Europe where hotels actually saw a greater recovery in August, boosted by the demand for staycations. However, Netherlands has seen like a resurgence of COVID-19 cases in September, and daily new cases actually reached its peak in December. So we are expecting a stunted recovery for the hotel portfolio. So just to conclude, our waiting for is a buy, and at a target price of $1.56. Next, please. Okay, so next we have Prime US REIT. So just a very brief intro again. Prime US REIT's portfolio comprises of 12 Class A freehold office properties that are located in 10 markets in the US. There are mainly 3 points to note. So on the portfolio management front, we like that there's high income visibility from Prime's portfolio. This is due to the high portfolio occupancy and long WALE, coupled with minimal expiries in FY20 and FY21, if you can look at the chart on the left. Yeah. So we can also see high levels of diversification underpinned by office using sectors like finance, legal, and infocom. They contribute more than 40% of the portfolio. No sector actually contributes more than 16% to the portfolio's net property income. Additionally, Prime's portfolio is well positioned to capture growth. Organic growth will come from the inbuilt rental escalations of approximately 2% for the portfolio. Low gearing levels of 33% will provide for more debt headroom to tap on for future inorganic growth opportunities. Amidst COVID-19, Prime's portfolio remained resilient. So rental collections are at 99% throughout second quarter and third quarter of 2020, and no rent abatements were given. Only rent deferrals were provided to small retail tenants, which contribute about 0.25% of the portfolio. Yeah, of the portfolio's gross rental income. Yeah. So our forward dividend yield for FY21 stands at 9.2%, which is attractive in our view, and we maintain a buy rating and a target price of 94 cents for it. Next, please. Okay, next we have Lendlease Global Commercial REIT. Brief intro again. LV's portfolio consists of 313 at Somerset and Sky Complex. We like that LV's portfolio is stable and is built for growth. So Sky Complex is an office asset in Italy that is 100% leased to Sky Italia in a triple net lease and a 12-year WALE. So this asset is very stable in our view. 313, as most of you know, is a retail asset located in the heart of Singapore. It's key to know that although 313's rental structure comprises gross turnover rent, fixed rents within LV's portfolio actually historically contribute more than 95% of the portfolio's gross revenue. Yeah. So amidst COVID-19, some short-term lease extensions and leases with lower base rents were provided in the first quarter of FY21. However, we do expect upcoming leases to be renewed at similar terms as before. Therefore, fixed rents will still remain a significant contributor to REITs portfolio. The inbuilt rental escalation for the portfolio will provide the organic growth for the REIT. So apart from rent escalations, we do see other organic and inorganic growth opportunities. The Grange Road car park redevelopment is a near-term development that we are looking at, set to be operational in the first half of 2022. This development is expected to generate a return of investment of 10%. In terms of inorganic growth opportunities, REIT recently acquired a 3.75% stake in GEM, a stabilized asset with high fixed recurring income. In the near term, is looking at acquiring more stake in GEM, and Landlease Group still holds a 15% stake in the fund that holds GEM. In the longer term, we believe that REIT will benefit from the ROFRs offered by the sponsor. So lastly, we find that REIT's valuation is attractive as compared to peers. REIT actually outperforms diversified retail REITs in terms of dividend yields, and it's also trading below peers in terms of price to book. So we maintain a buy rating for it. We maintain a accumulate rating for it at a target price of 78 cents. Yeah, that's all from me. I'll pass my time on to Ned for Escort.
Thank you, Jie Hui. So for my counters, the first counter will be Escort Residence Trust, and we think that Escort will have a potentially faster recovery than its peers due to the 74% of exposure to geographies or countries with large domestic markets. So for Escort, they hold 88 properties across 15 countries, and they have 8 key markets, which are the US, Japan, UK, France, Vietnam, Singapore, China, and Australia. So a large part of these markets are actually markets with very large domestic demand for travel. Second of all, we believe that service accommodation assets or select service assets are in a sweet spot because they are no frills kind of concept which may actually benefit in a post-COVID world, because flight ticket prices are expected to be more expensive due to the cost of compliance with safe distancing and sanitization measures. So budget travelers, corporate and leisure alike, may actually prefer a no-frills select service accommodation to offset part of their high ticket costs. But by no means are Escort's assets budget or economy class. They are still modern and luxurious assets, just that due to savings from perhaps dining in the accommodation, using the kitchenette facilities, that might actually cause savings for the traveler. Okay. Second of all, we believe that Escort will benefit from the brand recognition and loyalty programs that it will be part of. 71 out of the 88 assets are actually under Escort branded. Under Escort brands, sorry. So the Escort brands are Escort, Citadines, Somerset, and LYF Lift. So because a lot of these assets are branded under the Escort branded assets, they as Escort's brand sort of grows in prominence, they will benefit also from the exposure. Yeah. And I just want to draw your attention to the table on the left. So this is the number of keys that have been growing over the years under the Escort brands. So currently in 2020, you can see that there's about 118,000 keys that were signed, and only 48,000 of them are sort of still under development. So meaning to say, Escort has not yet reached its full brand potential with the current number of keys that are signed. Additionally, they still intend to grow the number of keys under their management to 160,000 keys. Yeah. So just for comparison here, Escort is 1/10 the size by number of keys of the largest brand hotel operator or hospitality operator, which is Marriott, and 1/8 the size of Hilton. Okay. The third of all, of course, is the debt headroom that Escort potentially has, 2.2 billion to reach 50% gearing, and we think that they will they will likely try to acquire, because they have divested 2 assets over the year in 2020. And we think that they'll try to shore up the stable portion of their revenue, which actually comes from master leases and minimum management contracts with minimum guaranteed income. So we think that they will pump some of these funds into stable, long stay kind of accommodation classes to shore up the stable income. So we have a buy rating on Escort with a target price of $1.15. We are forecasting a DPU yield for 2021 at 5.2%. Next slide, please. So Fraser Centrepoint Trust is our next counter. We have a buy rating at $2.79, FY21 DPU of 5.6%. So first of all, Fraser Centrepoint Trust has remained resilient throughout the cycles. This COVID-19 was also a testament to its resilience. And one of the main reasons why FCT is resilient is because of the recurring necessity-driven spending that occurs at their malls. So this is from the households, the families that are living in the housing units around their malls. 54% of GRI is actually derived from tenants in the essential services sectors or trades. So we see organic growth potential for FCT due to the increase in catchment size surrounding their malls, which will lift tenant sales. So 3 reasons. First of all, permanent hybrid work arrangements will increase the daytime population around the malls. Second of all, the 67.6% growth in HDB units that are under construction in the North area. So this will benefit their 3 largest malls, which is Causeway Point, North Point, and Waterway Point. And also decentralized commercial cluster in the North. So under the URA plan, the government is actually trying to create decentralized commercial clusters, and one of the clusters is in the North, and that will also benefit these 3 malls by increasing the office traveler footfall. Third of all, FCT's malls, 11 of them, they are very well located near transportation hubs, between 1 to 5 minutes walk from transportation hubs, your MRTs, your bus interchanges. And these well-located and well-managed malls will be prioritized amidst retail consolidation. Yeah. And last of all, of course, after acquiring the ARF funds, the ARF fund, which they bought over 5 retail assets and 1 office asset, they have increased their scale, and now they will be trying to leverage their skill to drive operational synergies through better contract terms and from third parties. Next slide, please. Next for me is Manulife. We have a buy rating with a target price of 92 US cents. Okay, so for Manulife, we see that they have a very defensive portfolio. First of all, low expiries due to a long way of 5.7 years. So drawing your attention to the first graph on the left, the percentage of leases expiring in FY21 is actually 6.7% by GRI. So that actually prevents their vacancy rates from actually spiking up too high, because most of their leases do not have break lease clauses written in. We will also expect some sort of rental growth from Manulife. This is because 95% of their leases actually have annual rental escalations of 2% per annum. Occupancy has remained relatively resilient. It has fallen, of course, during this COVID period to 94.3% as at 3Q 2020, but it still remains high and above the industry average in the US. Manulife has maintained a high collection rate of about 94% in the quarter of 2020. So they have provided a little bit of rental rebates for their tenants, about 0.3%. And 0.2% in deferments, something along those lines. Yeah. So last of all, Manulife, Manulife is, none of their assets are actually all in the US, and US is a mature remote working adjusted kind of office market. So that being said, we actually expect less impact from the work from home adoption in the US market versus in Singapore, where predominantly before COVID we were all working from the office majority of the time. Yeah, so we think that the US market actually faces less downsizing risk. So for that reason, buy rating on Manulife. Next slide, please. So my last counter would be CapitaLand. So CapitaLand, we like CapitaLand because of the earning stability from their very diversified portfolio. Drawing your attention to the pie chart in the center here, CapitaLand's AUM breakdown by asset class. So their current asset under management is $133 billion, and you can see that it's distributed relatively evenly, I would say. Okay, so this diversification actually helps to smoothen out the property cycles, the impact from the property cycles and the markets. We also like CapitaLand because there's a high proportion of recurring income. A high proportion of their revenue is in recurring forms, such as through their fund management fees from the REITs and private funds, and they collect management and franchising fees from their lodging platform, which is the Escort Limited, which is the property arm basically. And third of all, they also derive rental income from their investment property. Yeah. So actually, a very high, about 80% of their earnings are on a recurring basis. So that will provide stability and visibility, income visibility. So lastly, CapitaLand actually has committed to a $3 billion annual divestment scheme or target, and the aim is to actually divest mature non-core assets. Most of them are likely to come from the retail asset class, and to pump this to recycle the funds into new economy assets. Yeah, so some of these assets are like the logistic assets, which they are developing in Greater Tokyo as well as into China. Yeah. FCT is CapitaLand is currently trading at an attractive 31% discount to RNAV, and we have buy rating on them. So with a target price of $3.82. That's all for me. Moving on to Wee Kuang.
Okay, thank you, Natalie. So I'll be covering the first of my stock picks that is on buy rating, which is SGX. So on the left-hand side, you can see actually the breakdown of their FY20 revenue. So this is just to let everyone know they end their financial year in June. So this is a little bit outdated. It's been half a year. But the good thing about SGX is that they actually have a monthly data update on their capital markets movement. So this is something that can let us glimpse into what is likely to be the latest earnings that they are probably going to come up with at the end of January itself. So what we saw for SGX, we feel that they are very defensive and a very well-hedged stock. First of all, we saw that during the entire of 2020, they actually experienced a spike in market activity. And we see that actually this spike has been well sustained in recent months through the festive season. So if you see the table on the bottom left-hand side, across October, November, December, the capital markets in terms of equity side has been experiencing almost a 21% increase year on year for their daily average value turnover. And in terms of their derivative side, you can see that it is slower, but it's still positive as well for the entire first half financial year 2021. And I think the major thing that hit them at the start of the year, I think in May, was that they had a MSCI contract expiry that was going to come up in February itself. But we saw that actually for them, they signed a new agreement with FTSE in August, I think. That was way ahead of the expiry in February, the upcoming February itself. And we saw that even for the volumes that are coming in from these FTSE substitutes actually overtook the expiring contract. So at first they were guiding for 10% earnings impact based on their expiry, but right now we think that they will not experience any blip in earnings from the expiry of the MSCI contracts at all. And definitely over the past year has been a year of growth for them as well. We saw that they actually acquired BitFX and Scientific Beta to actually complement their current business segments to go into different segments. So BitFX is actually like an OTC FX platform, and for Scientific Beta, it helped to develop their indexing capabilities, which provides them more income revenue. So if you see the top left again, sorry, the three business segments that they operate, BidFX will likely go into the FICC, which is the fixed income, commodities, and currencies segment. And for the BidFX, it will go into the DCI, which is their data connectivity and index segment. Yeah, so this will grow their proportion in compared to their equities, which is making up about 72% of their revenue. So we see a stronger proportion coming from their DCI and FICC, which will diversify their revenue sources. And for them, they also have a very stable dividend. They are committed to a sustainable dividend, and based on their earnings that they have come up with over the past 1 year, we see that their quarterly dividend has been increased from 7.5 cents to 8.0 cents, which represents currently a yield of about 3.2 to 3.5%. And we feel that there is room for growth, especially given the earnings that they are experiencing. Currently, we have an accumulate rating on SGX at the target price of $9.45. I know currently the share price has already shot beyond $9.45, but do take note that our valuation-wise, we are actually pegging it to one standard deviation below their 5-year average PE ratio. So as we see, as the market starts to recover, we can actually price it at a higher PE level because this is not even their 5-year average PE. Yep. Next. Okay, the second counter that we have here from my side is Hypens Pharma. They're actually repositioning themselves for growth. And on the left-hand side, you can see their revenue by segment as of first 9 months of 2020. Short-term profitability-wise, Hypens Pharma will be a little bit hurt because of some of the inventory write-off that they will be experiencing. We've already seen it happen in the third quarter. They actually bought some test kits that they were intending to be distributed, but however, because of the centralized testing by the government and the efforts by the government itself, they could not distribute these test kits in Singapore. And so what happens is that they see that there's still these $200,000 worth of test kits that are likely to be written off in the upcoming quarter's results. Secondly, we see that as we saw previously from the sector outlook, right, when we take a look at the healthcare services, there has been an uptick which will likely benefit their sales. So we see that there's patients returning to specialist clinics, and we see that patients are also more open to visiting GPs. So this will help to boost their sales, especially for their medical supplies in terms of their distribution chain. And also for their long-term growth narrative, I think it remains quite intact. It is a very stable stock in a sense that they are taking a very long position. They have a very long runway. We see that the industry itself is very competitive for this kind of medical suppliers. However, so it is competitive, but there is a very long runway for them to grow. For Ocean Health and Ceradan, they actually increase their distribution agreements, and that will allow them to sell into more markets. And also recently, just 2 days ago, there has been an award of their e-pharmacy license for their well-away pharmacy segment. So we want to take note that because this is something that is new, they are also capturing this new telemedicine trend that is coming up during the COVID-19 period. However, because of the nature, is digitalization, we feel that there will be short-term wise, they will probably need to invest a little bit more into the business before it actually turns more profitable for shareholders. So ultimately, we still have an accumulate rating for them at a target price of 36.5 cents. And next. Okay, and lastly, for my side, the last stock call that I have is IX Biopharma. So for those of you who are not sure what it's about, IX Biopharma is actually a specialty, it's a drug maker, and they actually take part in a lot of activities of the entire supply chain, from R&D to manufacturing, to the sales and marketing, and even the local distribution of their products itself. And for them, I think they are a very high growth company. They are entering a very high growth phase right now. Currently, they are shifting their focus from R&D into commercialization, which will help to improve their profitability. Right now, they are still loss-making. However, what we are forecasting is that as they shift towards commercialization, we view that their revenue can increase in the short term. What they are expecting is there will be a sixfold in their manufacturing capacity by the second half of 2021. Similar to SGX, their financial year is from July to June. So this will help to benefit sales for them. and we think that their FY21 sales will see a 25% increase. And in terms of the prospects for them itself, they have this wafer that is ketamine wafer that is slated for a phase 3 development trial. Right now, they're sourcing their out licensing partners, and with the opening up of economies, we are likely to see that as travel becomes less restrictive, the deal progress will move, and we are hopeful for out licensing to be done within the financial year itself. I know we also see that there was this successful resumption of all these will be the large booster that will probably that is possible for them to turn profitable soon. So as such, we have a buy rating on them with a target price of 45.5 cents, largely to capture this deal. Yeah. And next, I'll hand the time over to Vivian to talk about Fortress Minerals.
Yeah, thanks, Wee Kwang. So I will be introducing about Fortress Minerals first. Fortress Minerals is an iron ore concentrate producer in Malaysia, and FY19 was their maiden year of commercial production. So you may be wondering, what is this iron ore? So iron ore is used in the process of steel making. And here are a few reasons why we recommend Fortress Minerals. First of all, a healthy 40% production volume growth is expected for FY21. And this is on the basis that for the first half of FY21, there was already a 57% year-on-year increase in the production volume to 231,000 wet metric tons. Secondly, the company enjoys high profitability due to their low cost structure and proximity to their domestic customers. So for FY20, they recorded a gross profit margin of 66.7%. As you can see from the map on the left, the Bukit Besi mine, their mining concession, is quite a close distance to two of their domestic steel mill customers. So the distance is about 100 kilometers for both. And with that, short delivery times are expected to ensure captive buyers for Fortress Minerals. Lastly, there is considerable exploration upside potential with only 5% of the total concession area of 526 hectares explored thus far, and mining rights will only expire in early 2033. So we have a buy recommendation that is currently under review. This is because the stock price has since increased to the target price, which was about approximately 35% increase. And this occurred in a short span of 2 to 3 weeks after initiating coverage. So do give us some time to think about the evaluation. Thank you. And I'll be passing on my time to Terence.
Thanks, Vivian. So we also have a buy rating on Kofu, and we see the one key catalyst as the TOP of their integrated facility, which is expected in the first quarter of 2021. So you can see the image on the left-hand side is the artist's impression of their integrated facility. The operations are expected to commence by 2Q 2021. It's been delayed slightly because of COVID-19 related disruptions, but the TOP of the integrated facility is expected to generate new income streams as well as cost efficiencies from food processing. And another obvious benefit with the TOP of the integrated facility and for Kofu is the sale of their existing central kitchen. That is expected to generate a special dividend of about 1.4 Singapore cents because of the $8 million gain from the sale of their existing central kitchen. For our last investment thesis for Kofu, we see the continued improvement in footfall month on month since the end of circuit breaker as being a positive for the group. Footfalls at their outlets in Singapore and Macau have been improving month on month since the circuit breaker. In the last 3 months of December of 2020, they've seen a sequential improvement in all of their outlets, though it's still a little bit small because of the lockdowns. So we have a buy rating on Kofu with a target price of 77 cents. In our next slide, our new addition to the Absolute 10 portfolio is Keppel Corp. We see for Keppel Corp, the strategic review of their O&M unit and the divestments to drive a potential re-rating of the group. So Keppel has identified $17.5 billion of assets for monetization over time. For perspective, Keppel's market capitalization is about $10 billion. So $70.5 billion of assets for monetization is huge for them. And this divestment of Capital's assets will be speeded up in 2021. They've already done about 3 divestments in 2020, and they're on track to achieve $3 to $5 billion in divestments within 3 to 5 years. If we take $5 billion, that's half of their current market cap in the next 3 to 5 years. So that's very huge for them. On the chart on your left hand side, you can see where the assets are coming from, a breakdown of where their assets are coming from. You can see land bank and projects under development is the largest segment, about 7 billion from there. We also expect the resolution on Keppel O&M. I think we have some questions on that, so maybe others address a little bit here on Keppel O&M. Internally, we see for the Phillip House view, we see the divestment of Keppel O&M to Sembcorp Marine as the most likely outcome of the current strategic review on Keppel O&M. And an announcement on this matter is expected in a few weeks because of the 100-day resolution. So we do expect an announcement on this in the next couple of weeks, or they could delay because they're trying to work out some of the details. But what we do see is Keppel O&M divesting their Keppel Group divesting their O&M unit to Sembcorp Marine. We think Sembcorp Marine will likely finance this through a green loan and a combination of debt and equity to acquire the Keppel Group. And as we mentioned earlier on, we think the weak environment will prompt this action sooner rather than later. And if Keppel do manage to resolve this issue, then we see the resolution as being positive for the group and will lead to a re-rating of its shares. Overall, this will benefit their long-term ROE target of 15%. And also the resumption of operations in their shipyards as well. So we have a buy rating on Keppel Group, our latest addition to the absolute net portfolio with target price of $6.12. So that's all from me. I'll pass on to Paul, who will conclude this year's 2021 review. Over to you, Paul.
So thanks, Terence. I think obviously we, as usual, overshoot in time. So sorry, everyone. I won't run through the conclusion. I think we self-explanatory. Just wanted to just highlight that we also we'll be issuing like a quarterly magazine. So this time will be on the real estate sector. So we'll explain why the residential market is resilient and so forth. It's in the link in the chat. So I think we have to run to Q&A. But don't worry, any of the Q&As, this is our analyst team. So if you have any questions, feel free to ask them. Then if you for all the Q&As that we do not reply, we actually will post it in our website. So under the community page. So don't worry if you don't get it, we actually do, but give us some time because there's a lot of questions. So we will actually compile all the questions and we will type them all into our community page. So if you have time, you can just scroll down and look for the answer. So we won't leave you in the lurch and not answer. But I think we'll just run through the questions. I think quite a number of them has been on the bank. So I'll leave it to Wee Kwong and the rest to take on the questions first. Wee Kwong, if you could. I think we will just take 15 minutes to answer some of the questions. And the rest we will just put them in SOX BNB community page. Wee Kwong?
Yep, thank you, Paul. Okay, I'll start off first. I think the first question that we have that is highly voted is that DBS, UOB, and OCBC, they're still a buy, hold, or sell, and what are the upside target price and downside cut loss price? So my views and comments on it. Okay, so for the target price wise, currently all our banks are on neutral, and our target prices are far overshot our target prices. I think for DBS it's about $22.60, and UOB is $21.10, and OCBC is about $9.80. Yeah. So my views on it is that we really need this clarity right now for the banks. Right now, in terms of outlook, we still feel that it's quite challenging itself, because if you take a look at interest rates is very low. Loans growth, it hasn't started to turn better yet. Although the banks themselves, they are expecting it to be a healthy growth this year, maybe single mid-digit kind of growth compared to last year, which was a contraction of about 2% year on year. However, these are some of the headwinds, and although we are expecting earnings to be lifted as we exit the loan moratorium, they come out and tell us that some of the allowances that they have been catering for is sufficient so that they can cut their provisioning. However, for them to actually return back to pre-COVID-19 levels in terms of income, I think it is quite unlikely in this current financial year. Probably need to return only in 2022. However, earnings, of course, is lifted with the lower cost, the credit cost that they are experiencing. So that is something that I feel will be holding back any upside for the banks itself. But of course, I think the next question that I have also is that why did the banks, Singapore banks, really move up in the last 2 days? I think generally the economic outlook has turned much better just over the first week of 2021. And we saw that in Singapore itself, apart from entering phase 3, we have also started all our vaccination process. So this gives people are kind of hopeful for economic recovery, a swifter economic recovery in Singapore itself. And if you really want to stay invested in the market, like Paul has mentioned, the STI is 40% made up of the bank. So if a bullish sentiment is really shows when you actually move the banking stocks. So it's like a cyclical thing, right? I buy into STI, the STI is made up of the bank's shares will move up along. And if people want to enter the banks to start getting into all these re-rating catalysts, it will also boost up the STI as well. So yeah, that's something that has been going on for them.
Okay, I think we will go towards the pigeonhole questions first. So let me just, the first, please share your views on dairy farms, Singtel, Comfort, and Raffles Medical. I think Singtel we've already discussed, Comfort we've already discussed. So for dairy farm, actually we don't really cover the dairy farm. The volume is thin and they only speak to investors and everyone only twice a year. So I think probably there's less. Probably you have more chance of watching an Andy Lau concert than getting a chance to speak to them, which is very rare. So basically, we don't really get much updates from them. So that's why we discontinue coverage on dairy farm. But for Raffles Medical, I think Vikon, can you help out on Raffles Medical?
Okay, for Raffles Medical, I think the fact that patients are returning to hospitals will definitely help them. It is a possible re-rating catalyst. But I think for FY 2020, what they have experienced is that the supposed opening up of their Shanghai hospital it had to be delayed slightly because of the COVID-19 situation, and the fact that they were supposed to break even for the Chongqing hospital, which was not managed, which they could not do it, will be still a little bit of drag in 2021. However, I think they will be able to turn it around in 2021 itself. Sorry, yeah, they will be able to turn it around in 2021. So in terms of outlook, there is possibility that this will be the year that they see businesses turning around for the China side, which will boost the overall earnings outlook for Raffles Medical.
Yeah, and just to add, I mean, the challenge when you open in China is going to be your ability to manage the doctors. I think that's going to be always a challenge because ultimately the doctors virtually call the shots. So it's not about running the hospital. I think it's the physical infrastructure, but the doctors is the challenge. So they have to, I don't know, hopefully they don't have to pay fees for that, but any tuition fees for that, but that would be the challenge. Let us move on to the next question. I think we have a question on city development. Natalie, can you help? Can you just read out the question and just help answer it?
Okay, so the question that we have is thoughts on city development with respect to recent board changes. Oh my gosh, and the sincere investments in light of the China property tightening. Yeah, so that's the question. Recently, there has been an exodus of some of the directors on the board. And this is largely due to the disagreement on the investment in Sincere. So Sincere is facing some, I think, liquidity issues and some major bank loans and trade liabilities that require settling, or and I guess also, yes, correct. There's there is a risk of further tightening in the China property sector. So Sincere actually has 71 projects, residential projects in China, as well as nine offices. Yeah, so I think one of the reasons why CDL wanted to invest in Sincere was because of the access to the pipeline of residential assets that Sincere has. So, I mean, given this situation, I guess that there is a likelihood that CDL will need to record some impairments with regard to this investment. We are still calculating the impact of the extent of the impairments required. Additionally, in a worst case scenario, we expect a higher financing cost due to more loans that need to be rolled over. In a worst case scenario, CDL will have to provide intercompany loans for them. Yeah. So we're still reviewing the impact to CDL from the Sincere investments.
Yeah, okay, thanks. So the next, I think the next one is, I already typed the comment, but let me just repeat the question from the pigeonhole. PropNex and agencies have outperformed property developers in 2020. Why? Do you expect the trend to sustain or reverse in 2021 and beyond? I think we expect the trend to continue. Just remember that if you look at the economics, obviously there's more money to be made in property development, but recently all the margins for developers are very thin right now. I think because of the ABSD, most of them they prefer to clear inventory and than rather to have any thick margins, because you can't hoard any more land, number one. And number two, the competitive dynamics, if you look at the market share, is very concentrated. So developers, agencies, only 2 or 3 large ones compared to developers where everyone will outbid for land and they will compete away or whatever margins they have. And the third one is, of course, the agencies, the earnings are mostly sustainable, whereas developers is so volatile, and nobody buys developers on PE ratios, or maybe in Thailand, but how much visibility does the developer after 1-2 projects probably give you 3 times per year? But I mean, most of them are already trading at a discount to RNAV. So we think right now the agencies can outperform, but of course the tail risk will be, unless the property market really skyrockets. Then if you look at how share prices of developers, they are very volatile. There can be years where they can just go up 20-30% if you have a very strong property market. So unless you think the property residential cycle is going to rise, really going to be a steep climb, prices going to have a steep rise, provided the government doesn't do anything, then I think developers can outperform. I mean, that is my view. Sorry to rush this. Okay, the next question is, both US and Asian markets have been very hot in the first week of 2021. From a macro and strategy perspective, what are your thoughts on the momentum sustaining for the rest of the year? So for me, Singapore is playing catch up. I think, as we know, Singapore has underperformed. So Singapore momentum, we think, can continue. What can drive? So for us, what can drive momentum would be what news flow can drive. So what we think would be how this whole the infection rate or the COVID cases, the curve. If the cases continue to bend downwards with vaccination, then that could be another driver to the market. And of course, when the new US administration comes in, if not the commentary, I mean, of course, we still need to see his actions, but the commentary coming from him, whether there'll be infrastructure stimulus, whether his trade policies towards China will be less aggressive. I think all this can help contribute to sustaining the momentum for the rest of the year. So we think the momentum can continue into at least the first half. For us, I'm not so sure about US. You probably have to ask Chun Rong, our US analyst. But for Singapore, it looks like it can sustain. There are lots of questions, so we can't answer everything. So let me just leave one more last question, and then the rest we will answer it through written, because we probably have like 50, almost 100 questions. We can't answer everyone. So Terence, I'm not sure if you want to answer this one. So the question is on the divestment. If the divestment of Keppel O&M to Sembcorp does happen, what impact will it have on the share price of Sembcorp? I think that will be the last Q&A we can take. The rest we will post it in Stocks BNB. So thank you for everyone's question, and apologize if we can't take it on live right now. Terence?
Yeah, sure. Thanks, Paul. Yeah, so Paul already read out the question. I'll just dive straight into the question. So for Keppel, if the divestment does happen, we think that Sembcorp Marine will likely do the acquisition through a combination of debt and equity. it's pretty well financed after the latest exercise by Temasek to take control of the group. Their gearing levels about 20% now. So in order to take on Keppel O&M, they will likely have to finance it through a combination of debt and equity. But we're not sure as to how what the terms of the acquisition will be like. So it's difficult to comment exactly on what's the impact on Sam Marine's share price, but it's likely that it will lead to a further dilution in the near term because of the acquisition. But in the longer term, we do see a merger between these two entities as being positive for the enlarged group, because they will be able to realize not just revenue synergies but cost synergies as well. Like what I mentioned earlier on during the meeting during the presentation as well, we expect an announcement on this by mid of January this year. So we'll provide a more detailed update when they make the announcement. So look out for it. And so that's all from me.